The EIA Uranium Marketing Annual Report, the numbers in there, I think shocked some people. I think they were hoping to see that the cupboards were bare, and the cupboards aren't bare, it would seem. But again, what was your take on what you saw?
Yes, the report came out, and it did catch some people by surprise because they were expecting a decrease, and I was in that category. What we saw was a small increase in the total composition of inventories held by US utilities, and a decrease in the total inventories held by US utilities and US producers of those nuclear fuels. So in rough terms, what we've got is an increase in U3O8 of about 5 million pounds. So to put that in perspective, at the end of 2018, the US utilities, amongst all of the different forms of nuclear fuel, had total inventories of 111 million pounds. And that's against an annual consumption of about 50 million pounds. So just over 2 years, which when you think that the fuel cycle itself takes about 2 years to move from U3O8 to UF6 to enriched UF6 back into an oxide and then fabricated into fuel rods, they were leaving themselves very little manoeuvrability if their only option for restocking was to go to the beginning of that fuel cycle and buy U3O8 and carry that U3O8 all the way through the fuel cycle. So what we've now seen is that number of 111 million pounds increase to 112,800, so 1.6 million pounds. Not that big a deal unless you were expecting or hoping another big drop, which is what we had between 2017 and 2018. Now, what I find interesting, the first comment that I'd make is, although I expected the number to go down by a bit, and it went up by a bit, it really isn't a big deal. We're talking about a small number of pounds in the overall context of the market. But understanding the composition of these pounds generates far more interest, and I think gives us far more clues as to how the market's operating at the moment than simply looking at one of those headline numbers. So what we've got is U3O8 going up significantly, about 5 million pounds. And that's a bit that was surprising when all you have access to is perhaps the summary numbers. What we know about this is that a large number of pounds were bought in the spot market at the end of 2018. That's when the uranium price was lifting substantially, shortly after Cameco put McArthur River onto indeterminate care and maintenance. And that volume for 2018 was about 88 million pounds through the spot market, with significant reactor or utility participation. What would have happened is the vast majority of those pounds purchased in the spot market would only have settled for delivery in 2019. So what we've got here is something of a smoothing effect. Between 2017 and 2018, there was a fairly dramatic fall in U3O8, and that was smoothed by those deliveries taking place in 2019, which then increased that number. So that's the first thing to understand. The second thing is just talking to people inside the industry. There seems to be a view that one utility in particular had bought quite aggressively and opportunistically in the spot market when prices were low. That is also going to distort those numbers to a significant extent. And if you'd taken that one utility's numbers or its aggressive spot buying out, then that would all but even out that U3O8 number. So that one utility, from what I understand, is a substantial proportion of those 5 million pounds where the U3O8 price has gone up. So for those two reasons, I don't think it's valid to see this as a broad indication of the functioning of the market, the health of the market, the attitudes of US utilities and so on. It's partly a function of how the spot market works, or how ineffective it is, you could say, and the activities of one particular utility. So the next thing that's interesting is then to look at the downstream nuclear fuel components here. So UF6 dropped by £3 million, and EUP dropped by £4.5 million. For the audience there, they're not measured in million pounds. These are all converted into the equivalent of U3O8 pounds. And then correspondingly, fabricated fuel, so fuel that's in rods ready to go into reactors, increased by about £4 million. So what to understand there? First of all, the increase in £4 million in fabricated fuel is not surprising in the least, because we've got quite a glut of refueling outages coming up in the spring and then the fall of 2020. So the utilities would have needed to finish 2019 with strong levels of fabricated fuel so that they could do that refueling. So that I would have totally expected to see. The UF6 and the EUP dropping, that is indicative of the tightening of those markets that we've discussed before, and also reflected in the price of conversion, for example. And then if you look at the supplier inventories, they dropped by £5 million, although the supplier numbers of U3O8 only dropped by about £1 million, even less than £1 million. So what that's telling me is we've got utility downstream dropping, and also supplier downstream dropping as well. So those two numbers together indicate quite a significant tightening of UF6 and EUP within the US market. And when you add those numbers together, that's close to 20% of annual consumption that's tightened in that way. So in summary, lots of interest from it and lots of indicators. And I would have liked to have seen it drop by a couple of £1 million as a whole, rather than go up by a couple of £1 million. But when you do add back those producer changes, the total number of both utilities and producer inventory contracted by about £3 million, which is reflective of what we understand, which is an overall contracting in inventory around the globe.
So what does this now tell us? Because, like I say, I keep saying I can't believe how opaque this is. Opaque is the key word for this industry. What does it tell us about how long utilities can keep going without necessarily being impacted by, obviously supply disruption because of COVID, and more generally, with production when things do come back online? Can they string this out to the end of 2021 before they come back into the market? Because if I look at the long-term forecast from UXC and TradeTech and so forth, we're talking 2021, 2022 numbers of below 40. I mean, what's that? That is a big impact for uranium juniors hoping to get into production and get finance to be able to try and get into production sometime soon. So again, what's your take on timing now that you've seen these numbers?
Well, what it tells us is US utilities across all of their components of nuclear fuel have still only got just over 2 years of inventory. That leaves them very exposed to a shortage, which could be generated by geopolitical reasons, it could be generated by other commercial reasons, and in particular, it leaves them very exposed to a shortage of EUP or UF6. And the reason I say that is two and a bit years does sound like a lot of time, but not if you have to go through the entire nuclear fuel cycle. So if there's a shortage, for whatever reason, they have about £12 million collectively across the whole industry that gives them that buffer if they can't buy EUP or UF6 in the marketplace. So that leaves them vulnerable. And so it tells me two things. It means that this sector is well set up for some form of catalyst. And, given what we've been talking about, there's every chance we'd see a geopolitical catalyst here. And it also tells me that this sector, and the US sector in particular, remains ripe for a reevaluation of risk management and procurement strategies. Carrying that little inventory, given the amount of risk that's out there to supply in the sector, both commercial and geopolitical, seems to me to be bordering on irresponsible. And I think there's, in my opinion, there's got to be some realization generally speaking, amongst the utilities, that they need to manage their risk in a different way. And it's going to come from all sorts of different directions. We've talked about the carry trade diminishing. So that was one of the key risk mitigants that the utilities could use. They could just maintain their current inventory level, knowing that they can buy on the carry trade for delivery in 1 or 2 years' time. The other risk mitigant that they were able to use is to buy EUP 6 months out of when they needed to fabricate, rather than buying U3O8 1.5 years out of when they needed to fabricate. But if any of those risk mitigations fall away, and I think both of those will become less available over the next year, the utilities will have to go back to using U3O8 as their primary risk mitigation via long-term contracting. And I think that's the setup that we're all looking for by the end of the year.